refinance next year, 2.7 trillion by 2027. It's a problem that many people are discounting. But I do think it's going to be an incredible opportunity to invest in real estate. I really do. When all of these assets start getting repriced, then you start to see some pain in the street, some blood in the street, as they say.
Yeah. So what he's saying though, I think he's looking to rent out his place now. Arak, what I would do is I would look at what are the other units, the comps in the area. You can go on Zillow right now and just kind of see the comps. Now, obviously, John, I'd like to hear your input. Don't, price it way higher than it. Don't go much lower than it. Try to find something that obviously covers your note, covers your expenses, but you do got to leave a little wiggle room for the HOA fees, for the property tax, for the insurances that could keep going up. And, some of these HOAs can be absolutely crazy. So it's really going to depend on the type of property that you're in. So John, what do you think he should do in his situation?
I would personally rent the property out for every penny you can get for it to the best and highest quality tenant. Mm-hmm. At the end of the day, owning property and being a landlord is all about supply and demand. You're supplying a service and a product, right? You're supplying this to the tenant. In response to you supplying it, the tenant is going to pay you for it, right? So if you're offering a great opportunity, you should get top dollar for that. Just like if I were to sell this iPhone, right? If I were to sell that iPhone, I'm not going to go there and be like, who's the nicest person in the world? I want to find, a single mother that I can give this phone to for $5. I'd want to list it online and try to find the best buyer for it, right? I'd want to find the best solution. When you own property, it's not just about getting the most money, but it's also about having the equity and having the money coming in that you can offset a loss if you step into a problem. Because you might say, oh, my expense is only $900. I'm going to rent it for $900, right? I'm going to do the right thing. But then let's say your water heater goes out. Let's say you have a leak in the roof. Let's say something else happens. Okay, you need $5,000. You don't have the $5,000 and you don't have any money coming in above your costs. So what are you going to do, right? So squeeze everything you can get out of the property to build that rainy day fund and offer that tenant the best experience possible for the tenant. Offer a great win-win relationship. But at the end of the day, it is a business. You have to treat it as such.
Yeah, Eric, thanks for that question. Great answer, John. Look, for anybody just joining us, if you want to type your questions in the chat over here, John and I will answer. Now, John, I want to circle back to this article, the CNN article. Florida homeowners insurance rates are 4 times the national average. That's not getting better anytime soon. Now, John, I am a licensed insurance adjuster. So my strategy, and I don't even know if it's a good strategy, but I've been saving because I'm with you. I think the crash is coming. And I think that if I position myself to buy a property cash, that I could get basically just and again, guys, this isn't financial advice. This isn't real estate advice. This is just us talking. But I'm thinking about just maybe getting just a fire policy, just the most basic fire policy where I'm covered if a fire happens, right? So do you think that this is a good strategy? Because at what point do we have to just self-insure if the insurance rates are going, this is just too high? Like we're not getting what we're paying for.
Yeah, it's a good question because a lot of people are now self-insuring. And I think it's going to be, what that means for people that don't know is that you essentially assume all liability in the event of a disaster, a fire, a tenant lawsuit, any type of problem. If you don't have insurance, you're coming out of pocket. You're the one liable. And then that property is collateral for that. So just know that. If you're going to get fire coverage, you're going to get certain insurance policies. Like, sure, it might make sense for you. But at the end of the day, if it's only going to cover you on a fire and you're not in a fire area, then you have to, weigh the cost versus the benefit.
Yeah. So let's go back to what, to your credit repair. It should be listed. I'm sorry, John. They're saying the stream's not listed. It should be listed. It's live. I apologize, y'all. Technical difficulties. It looks like we're good. Can y'all let me know in the chat? Are we good? I apologize, John. Let me make sure this is going right.
No, you're good, man. Take your time.
I got about 30 more minutes, which is that good?
Yeah, 30 is good.
All right, guys, we're back. I think we had a little technical difficulties. Appreciate y'all tapping in. For those of you just tuning in, this is John Williams of Get Credit Repair Fast. What is it, John?
GreatCreditFast.com.
Yeah. So John, break us down. So like, let's say, we're preparing for this transfer of wealth. We're preparing. All right, we're good now. Thanks, Daniel. We're preparing for this big event that, you and I both think's coming. And, it's one thing to talk about being prepared, but getting your credit right, being prepared for that, not waiting for the crash to be prepared, being prepared in advance. We need to be prepared. So what do you think is the best move right now for people that maybe a lot of people probably don't know what their credit score is?
Yeah. So a lot of people think that, a 600 or 650 is a good credit score. The national average in America is 698. So just under 700 out of 205 million Americans, right? And if you look back to 2009, 2010, what happened? Banks tightened up lending on those that offered high risk. Well, how do they determine that? They look at your track record. They look at your credit score. They look at who you are as a borrower. And so if your credit score is not where it should be, in my opinion, if it's south of 750, probably should look into why that is. If you have one late payment, it can drop your score upwards of 180 points. So it's astronomical. You could go from having great credit to bad credit with just one little thing, and it will sit on your report for 7 years from the date in which it was filed. If you file
7 years for a missed payment.
Yep. If you file Chapter 7 bankruptcy, it'll sit on your record for 10 years from the date in which it was filed. So a lot of these items are disputable. Like, you're able to get these items removed. So looking into this and kind of like building out a game plan and a strategy is smart if you intend to invest when things hit the fan. We offer a free consultation at greatcreditfast.com. We'll give you free advice, tell you what it would likely look like, our strategy, how we go about it, what we would suggest. You can go to greatcreditfast.com and book an appointment.
Yeah, guys, I put the link to that. I'll put it in the description of this video. So John, I think a lot of people, their credit score gets them discouraged because a lot of times they're not educated on the importance of credit. They're not educated on, like you said, I didn't even know that it stays on your report for 7 years. Yep. So it can be discouraging, but let me give a little insight that you don't need an 850 to qualify for a decent interest rate. I mean, what is kind of the lowest? Is it like around like 760, 780 to be able to qualify for the best interest rate?
780.
780
above, like, you're in a really good spot.
Yeah. So guys, if you're into real estate investing, look, I'm not telling you to get a lower credit score, but if you can get it anywhere from 780, anything above that, that 850, you're just showing off. You're just bragging to your friends at that point. Yeah. So, let's go back to this screen, John. And this still blows my mind that, Americans' credit card debt hits a record $1 trillion. And, the reason for this, what I think part of the reason for this is that this push to go cashless, this push to, essentially bribe people to use these rewards-based credit cards, these credit cards that give cash back. So is this what you're seeing in your business? Are you seeing that this is these credit cards that people wanting to just swipe everything? Is that what getting people in trouble?
No. Believe it or not, half maybe, but believe it or not, the other half are bad relationships with their significant other, dating someone, signing on a car note for somebody. Maybe they were, just in the wrong place, the wrong time. They got their identity stolen. A variety of situations like that are probably half of the cases. So be really, really careful when you co-sign on anyone or on anyone's loans. Just be cautious of that. Because things could be great today, but, just because everything has been good with that significant other for, a week or a month or a year, doesn't mean that if the world gets crazy, they lose their job, that they don't mean to, default on these payments, but they have no choice but to, and then you end up, getting pulled down with it. So just be cautious of co-signing.
Yeah, I've heard of that a lot. People trying to help out, somebody they're dating or a friend or something by co-signing and, thinking that, hey, nothing can go wrong. This is my friend. Well, anything can happen, guys. What can go wrong will go wrong. Now, you said y'all offer a free consultation for people that, are interested in this or, like I said, most people, if you ask the average person, I don't think they know what their credit score is.
Yeah, and the average person goes on Credit Karma and thinks that's their credit score when it's not. How Credit Karma works, and a lot of people don't know this, but how it actually works is that that entire business model is based on selling you financial products and services. So whether it be a credit card or a personal loan or a business loan, you ever notice at the bottom it says odds of approval? Great, odds of approval, excellent. It's because they'll get $100 to $300 on an affiliate commission if you click the link and sign up. So they just try to put as many products in front of you as they think you could possibly get approved for. They're not guaranteeing you get approved, but they're like, hey, there's a chance that he can get approved for this. So we're going to go ahead and present him with this opportunity, and we'll make the money if we can. And if we can't, it is what it is.
Yeah. And so there's 3 different credit bureaus that your credit score is being pulled from. So all those 3, it's not the same.
No. So Credit Karma is a third party. It's just like an app that they don't pull the scores directly from their credit bureaus. They pull information that is pulled from their credit bureaus. So it's like a third party that they're not getting it directly from Experian, TransUnion, Equifax. They're getting it from another party. So you just want to be really, really careful when you're not getting information directly from the 3 reporting agencies.
Yeah. And look, guys, the last thing you're going to want is for, everybody talks about, man, I wish I could have bought houses, during the pandemic or during all these crashes. And a lot of people, they're not even going to be prepared for this because their credit scores, shot. And, guys, it sucks. It sucks. It sucks that, a country that's like trillions of dollars in debt is assigning their citizens a credit score. But I'm preparing, John. I've got my credit right. I'm prepared. I'm, watching the markets, but there's always a curveball. And let me show you this article, John, because this is, and I was thinking about buying a place in Florida, because I have a couple places in Louisiana, but it's unfortunate that, as much as I love the state of Florida, they're dealing with the same stuff Louisiana, Florida insurance premiums might not go down, industry says. So inflation, the cost of reinsurance, and the key word you said, climate change, keep driving up rates. So as CNN said, the climate change narrative's here and it's not going away. So, John, is there any hope for the Florida insurance? Is there any hope?
Florida is going to be an all cash market, I think, in the coming decade or two. Right now, people are, they're like, okay, and it might go up 10%, 15%, 20%. Okay, not a big deal. But what they're not realizing is a company like Citizens that has market share, and a lot of these big conglomerates that have market share. As these companies, if they walk into a big storm and they, go under, you're going to start seeing every other insurance company looking at risk differently. So I believe we're only 1 or 2 big things away from a situation where people aren't going to be able to afford insurance. And with a place like Florida, 1.7 million homes are vacant. 1.7 million, 17% of the entire housing stock. Think about that. Out of 100 homes, 17, no one's living in them. And the reason for it, retirees and snowbirds, right? So when you have this situation, that's why Florida, just like Vegas, is a boom bust market. Look at the GFC, right? So if you walk into a situation like this where insurance rates continue to rise and the economy is contracting, I think what's going to happen is Florida value is going to come down. This is coming from someone that owns property near the coast in Florida. So I have seen my rates go up, right? And so a lot of people have, and I'm prepared for, fortunately, I don't have a mortgage on my property, but I'm prepared in the event that, something happened, whatever, right? But a lot of people aren't going to be in that same situation.
Yeah, guys, I've been to Florida and I've seen, where it's like, the little town I was staying in, Sarasota, where it was empty. And then the snowbirds come down. All of a sudden, it's like a whole influx of people. So I think what John's trying to say is a lot of those properties might come up for rent, which is going to pull the rents down. And look, guys, there's some more people joining the chat. Guys, if you got any questions for John or I, anything about real estate or credit, now's the time to ask. Just post them in the chat. I'll paste them up here and you can watch John and I answer them live. Right now we're talking about the crazy insurance prices in Florida. So you're thinking that Florida is going to become an all cash market, meaning that the average Joe, me and you people watching this, are going to be competing with the BlackRocks, the State Streets, the Vanguards, these big institutions. Do you think that's what's going to happen to Florida, John?
Yeah, definitely. But it's, again, I want to heavily weigh on this, that it's not going to happen overnight. It won't happen in a year or 2 years or 3 years. We're going to see what I believe is going to be a significant tightening in the insurance market in Florida. And over the years, we're going to see more and more players get wiped out. There's going to be bigger and bigger companies that are going to rise up. And I think what's going to happen is many of these companies are going to start to go bust. And as that begins to happen, it's going to become a situation where there's going to be a lot more sellers desperate for a buyer and a lot less buyers available. And so the only buyers that are going to really have that weight are going to be the ones that come in with cash that don't need insurance. So I think that is what's going to happen. It's going to probably be, a 5 to 10 year horizon where we're going to see Florida becoming much more of an all cash market.
Yeah, and so Jeff Mayer just posted a question. Jeff Mayer is actually my mortgage lender, and he said, "Have you heard anything about the Gulf Coast joining together to get a group plan, Texas through Florida?" I haven't heard anything about this, John.
No.
Have you?
No, I never heard.
That would be probably a good solution because it would spread the risk. I would think that, if these states could come together to work something out, but
that's like considering that everything is done correctly. When we look at what's going on, I believe everything's happening against the citizens, not for them.
Mm-hmm. Yeah. So I think that I think so. Like, I'll use Louisiana, for example. State Farm, the parish that I'm in, State Farm does not write homeowners insurance policies in this parish, but the state allows them to write car insurance policies. That's kind of the problem right there, because they're making the money on the car insurance policy. So if these states would put a little more pressure on these insurance companies, I think that maybe we could get something done. I don't think it's a situation where I will never believe that an insurance company can't be profitable.
Oh no, insurance companies print money. Like their whole business is to assume money, assume these premiums, assume the monthly float, and struggle to pay out consumers. So I mean, how do they not make money? If it's like, it reminds me of the movie Casino. He's like, when I win, I get paid, and when I don't win, I don't pay, right? And so a lot of these insurance companies, they look for all these different ways out to not pay. So yeah, and over the last couple of years, they've only made more money as premiums have continued to rise, I believe.
And premiums are going to continue to rise. And what it seems like, John, is that these insurance companies go belly up, and what happens? The government bails them out, and you see these Florida citizens, and you see these different companies come in. And, if you're a business and you're incentivized essentially to go under, you have no incentive to protect policyholders. That's what it looks like is happening to me. Now, you mentioned you're self-insured. Do you have any concerns over doing that, being that you are, in an at-risk state?
No. And to be fully transparent, I don't really care what happens to the property. So I was in a situation a couple of years ago. We moved here. We weren't really intending to stay. We were renting a spot in a high tourist area, a lot of demand, right, not far from the beach at all. And so a lot of people come to this specific area, and during high season, rents more than double. And the landlord's like, "Oh, we're going to be increasing the rent and basically doubling the rent on you." I'm like, "Okay, well, I'm probably going to look for another option." Had a family member come into town. They were staying at a nearby hotel. Wife was having a second baby. My family member was talking to a lady at the front desk. Like, "Oh, my friend's mom wants to sell their home. She inherited it. Her mom's passed away. They want to just get rid of it." And so what they're really looking for is to sell it as quickly as possible, because there was a lot of emotional attachment to the property. They just wanted to turn their back on it. And so I offered a number that I thought was fair, which was definitely below market. And they accepted it. And yeah, so if some type of disaster happens, then, it's fine. If something doesn't happen, that's cool too. Like,
yeah. So ideally, I would like to be self-insured. I would like to have enough property spread out where essentially I become the insurance company. Now, John, one real estate dilemma that we probably haven't talked. I don't know if you've heard anything about the Airbnb crisis that's kind of happening right now, where the Airbnb numbers are dropping. So, you see all these YouTube gurus talking about, get all these Airbnbs, get all of these leases, and take on all this risk, all these Airbnbs. Well, if those properties start going vacant and they're not able to make their notes, so those properties will, one, come on the market for sale, which would add more inventory, but two, also be competing with rents, because if you're not able to Airbnb your property, but you're able to get a tenant to, even if they just cover the mortgage, don't you think more people are going to start doing that?
I think the Airbnb, and this is my opinion, and I covered this Airbnb thing. Like, if you Google like Airbnb or on YouTube, like Airbnb bust and type my name in, I was talking about this coming a year ago. So like, it started becoming much more mainstream like 6 months ago, but I was pointing out this is what's going to happen. And I kind of listed all the facts in there. But right now, that Airbnb situation pales in comparison to a variety of other problems that are happening. So like Airbnb, there's only 660,000 Airbnbs in America, which is a lot. Like, I'm not saying it's not a lot, but when you take into consideration that retirees own 55% of the entire housing market, I believe that there's much more of a likelihood that there's going to be more stress from retirees in the coming few years than there is going to be in Airbnb. I think of the, let's say, 650,000 of them, a lot of people are well off. A lot of homes are paid off, right? A lot of people have the ability to increase their, their costs on their property, and they can still absorb them through increased premiums or reduced rental rates or whatever. But there's going to be a lot of people that they overpay for the property, and even if they wanted to rent them long term, they still can't afford to because of increased insurance rates. And maybe they took a hit at their job and they can't have two properties, one of which is not producing income. So you're going to see, I think, stress in Airbnb, but I don't think it's going to be as bad as other problems.
John, Jeff just asked this. He said, what's the future of Louisiana's insurance market? All cash like Florida? Residents will be forced to move if premiums keep rising? Agree? What do you think, John?
I think insurance is just going to be going up in a lot of markets along those areas that are, problematic. Like over the next couple of years, that is what I think is going to happen. I don't think that it's going to be a market to where the average school teacher is going to be able to own a property and maintain that property over the coming decade on a school teacher salary with basic living expenses. I don't think that's going to happen. I think a lot of people have to pay all cash. They're going to have real money coming in. Like, I honestly think that in the next 5 years, $100,000 a month is going to feel like $10,000 a month today. Like that's what I think is going to happen.
Mm-hmm. Yeah. Essentially, I think what John's saying is we're becoming a nation of renters, and you will still have landlords, you will still have people that own property, but it's going to be more of these big corporations buying all the homes, these not just the BlackRocks, but big property groups, LLCs. Now, Jeff asked this. This is an interesting question. Do you see a housing market crash when all the baby boomers die off and flood the market with homes?
Yeah, I mean, the thing is, though, like, I think we have to pay attention to what's happening in the job market, right? Who's going to be able to absorb these homes? I think that, CNBC and MetLife Insurance came out and said by 2030 that 40% of all single-family homes will be owned by institutional investors. So that's an 800% increase from where they are right now, right? So how is that going to happen? Honestly, how is it going to happen? Obviously, we're going to see a big structural change in this economy. There's no doubt about it. If you look at what's going on in the world right now and you start connecting the dots, everything is ramping up. Every week, 2 weeks, there's some big story, some breaking story, right? It's normalizing the citizens for chaos. So we're stepping into a world of chaos. We're not stepping back into, a soft landing. And I think that's going to have a really, really big impact on the job market for people that are absorbing these properties. I think it's going to be the big corporations buying them, not, Joe the plumber and Sally the nurse.
Yeah, I think John's right. I gotta agree with that. That we're going to be competing with big institutions for these properties that have cash offers and are going to be utilizing a lot of technology to find these deals. So, John, you were a real estate agent in Beverly Hills, correct?
Yep, 2009 and 2019.
Okay, and now you're in Florida. Now, that to me, two different coasts, two different states, two different, blue state, red state. Where do you see more opportunity? Because as we know, California and Beverly Hills real estate hyper appreciated. So I would think that as we go into this crash you're talking about, perhaps the opportunity is going to be more in California.
Definitely. So I love California. All my friends are there. Half of everything I've learned is from clients and people that I've worked with in Beverly Hills and, in that area. So I've learned a lot about negotiation and business and different things from a lot of these very wealthy players. I've been fortunate enough to represent some of the biggest names. And by doing so, it's really kind of elevated, who I am as a person. But now being here in Florida, I feel like I'm missing out on a lot of those contacts, right? And so it's a problem. But when I'm looking at what's happening right now, if I were to go, let's say, buy a multifamily property, which I would love to do, I could make a lot of money doing value add multifamily in LA. But if you look at what's happening in landlord tenant law in LA with rent control and different regulations, they're talking about bringing in things like vacancy control, where if you buy a building and the tenant moves out, you're not even allowed to increase the rent to market rent. You have to keep it at that low rent. So they're working on all these new changes, all these policies that could be detrimental to property owners and investors. So right now in Florida, like, yeah, sure, the market's crazy, insurance going up, the world's kind of getting weird. Deals really don't pencil that. Like, for most deals, don't pencil. Like, I'm not going to say you can't find a deal. You can always find a deal in any market, but they're getting a lot harder to find and a lot harder to finance to where it would actually make sense to buy. So I think in the coming 6 months or so, I think we're going to learn a lot. And depending on what I learn, I may move back to California.
I'll be shocked if that happens, John, because, the way the world's going, like you said, with all the crazy, like kind of like, that's why I stay away from condos, because of them HOAs. I don't want them to force me to do some kind of crazy upgrade. That's what's look like is coming to California with all this climate nonsense. Now, John,
coming to Florida too. People don't know that. Like, so I had on my podcast, like 2-3 months ago, my first guest, I went on miamidade.gov. And I looked at, okay, who's the sponsor here? Like, who's pushing these agendas, right? One was a company called SELF, Solar Energy Loan Fund. And so I called them. They didn't call me back. I called again. They're like, okay, well, maybe I can connect you to somebody else. They connected me. I kept calling, following up. Got this lady on the phone. She's like, okay, yeah, I'll come on your podcast. I'm like, cool. She came in, and I'm like, tell me what's going on with all these upgrades. Like, and we talked for like 30, 40 minutes, maybe even almost an hour. We have to check the podcast on my YouTube channel. But I was asking her about it. She's like, yeah, these are all going to be mandatory. This is Miami, dude. Like, this is Miami. They're talking the same thing in San Antonio, Houston. This is going everywhere. There's no like exclusions. It's happening in Philly, in Boston, in Chicago, in New York City, Atlanta, all these markets. If you go to c40.org and you click our cities right at the top, boom, you'll see our cities. It'll show you a map of the entire friggin' world. And it will show you the map of America. When you click, west, you click west, it'll show you the map, and then you click on the city, and then it'll be a drop-down menu, and then it will show you all of the initiatives that they signed on to. So this is happening. Doesn't matter if it's California or Florida. I do think California will be a hell of a lot more extreme in the onslaught of it. Like, they're going to be more aggressive initially, but Florida is going to be right behind it.
Yeah, New Orleans, I live right outside New Orleans. They're listed on c40.org as a C40 city. And if you guys don't know, like, I don't even want to say some of the stuff on there. Just go see it for yourself. Go to c40.org. No private car ownerships, no eating meat. I think we got to wear like a uniform. We're not even going to go there, John, because they're just not going to believe us. But Jeff asked another question. He said, so glad you brought up the job market. How do you feel about the Fed's job report, the JOLTS report? Are they accurate? What do you think, John?
Yeah, well, just one thing to touch on that, what you just said. I would, rather than believing on any of that, I would just click on our partners and just read through the list of people or list of companies, World Bank and
Google.
Yeah, I mean, like,
Clinton
you look
Foundation,
at Society Foundation, Clinton Foundation, the entire government of the UK. You look at all these and be like, okay, are these people wrong, or is this just too extreme for me to believe? And then you start to look at it, and then you form your own opinion. Don't listen to us. But anyway, so glad you brought up the job market. Do you feel that the Fed's job? I don't feel like anything the Fed says is real. The inflation numbers, the CPI, like their job numbers. I mean, really, when you go to the grocery store, when you pay your energy bill, when you pay anything, how is it when you add up everything that you're personally paying, it's 15 to 20%. You add up 15 numbers, all 15 to 20% increase, and then you add it all up and you divide by the amount of numbers, and you're like, okay, CPI is 3%, like, or 4%. It doesn't make any sense.
Yeah, I think a quote I saw was the government lies using statistics. Like, that's one of their favorite things to do. So do not believe the jobs report. Do not believe the CPI data numbers. Go to the grocery store. Go see the price of eggs and make your own financial decisions. Now, John, Antonio Gagliano asked, do you have any advice for a first-time homeowner? I'm wondering if I can get a duplex and live in one side while paying the mortgage. Any thoughts, John? So I guess he doesn't own a home yet. He's renting. What do you think of this?
Yeah, great question, Antonio. I think a lot of people are in the same position. So my advice that I would give to you is the advice that I followed. I didn't go with a duplex or single-family home. I went with a triplex, and I looked for a way in which that I could add value to that property, whether it be increasing rents or adding another unit. I was constantly looking at how can I reduce my overall cost of living by moving into the deal, and what is the big exit, what is the big play here that I'd be able to force appreciate this property to make money on this first deal and use that first deal as a vehicle to get me to the second deal. And so you always want to look at that first deal as not as, the be all end all. The first deal, every smart real estate investor that I'm friends with, is all the same thing common, same with me, is the first deal worked out well. And so the first deal you have to buy has to work out really, really well. So the duplex is good. You're on the right path. But if you bought a fourplex, it's still considered residential. You can still get a 30-year fixed rate loan. And the net income from these units, these other units, can be applied with your income. It's easier for you to qualify for these deals. So being strategic about trying to buy a triplex or a fourplex and having, buying it in the right area to where you can increase the rents. Like, you need to be able to increase the rents. If you're not increasing the rents on the deal, you're not building equity. You're not building value, right? And so when you resell that building, you're reselling it based on the income that new buyer would assume having bought this property. So we want to buy in like an area that's gentrifying. Like, one easy way to look at this is like, what area is very, very expensive, maybe across the, train tracks or across, one little intersection where, you're starting to see some growth in that area, but it's just not there yet. You can still buy, a really good deal there. Buy that deal, force appreciate it, and sell it.
Now, John, I'm gonna play devil's advocate because I do agree with what you're saying. But if we listen to popular YouTubers such as Grant Cardone, they would say, don't do that. You give Grant Cardone the money to buy a big 500 unit apartment complex. I mean, so what do you think of that?
I don't think Grant Cardone likes me very much. He did a YouTube video bashing me because I was telling people that I think you're much better off to invest in your own deals and make your own money than investing with him for a 5 or 6% return. I said on a Instagram post, I said, what real wealthy person do you know that invests with somebody else at a 5 or 6% return? And that's how they built their real wealth. They did it. None. They had this big vision for their future, and they went out there and created it, right? That's what people need to do. If they want to become wealthy, they need to figure out their own game plan, their own strategy. They need to create their own wealth. To get to a point to where you're worth millions and millions of dollars, if you want to put, $1 million in this fund or do that, that's one thing. Cool. Do it. But if you're just starting out and you have 10 grand, go putting it with somebody for 5% return, 6% return, that's not net of fees. After net of fees, you might get 3.5%, 4%. If inflation's 12 or 15, you do the math.
Yeah, and going back to Antonio's question, Antonio, I would advise you to go to John's website, getcreditfast.com, because if you're planning greatcreditfast.com, because if you're in the market for a house, you got to have your ducks in a row. You got to be pre-approved. You got to get it with a mortgage lender. You got to get your credit right. There's so many steps before you can buy the house. So the last thing you want is the deal to come up, the duplex you want to come up, and then you call your realtor and you're not pre-approved. Your credit's jacked up. You got a late payment. You got something on it. And that's what John's here to kind of try to help y'all with. Now, John, Jeff said you can get an FHA loan with only 3.5% down as long as you live in one unit up to 4. See, I thought it was up to 3 units, but you said your first deal was a triplex, you said?
Yep, triplex.
And going back to Grant Cardone, guys, fact check me on this, but if I remember correctly, Grant Cardone's first deal was a single family house in Beverly Hills that hyper appreciated because he did what John said, and he bought in an area that was appreciating and then used that deal to launch his entire real estate empire. So, but yeah, so an FHA loan. So what, to get an FHA loan, what is your credit score need to be a certain thing? Do you know?
I wouldn't do the FHA because of something that just came out with, who is it? Fannie and Freddie. I think they're doing now 5% down for 1 to 4 unit properties. So you don't have to get the insurance, mortgage insurance. That's starting in November. So
that's the PMI.
Yeah. So you don't have to pay the PMI. So you put an extra 1.5% down, but you get out of paying PMI, which might save you $100, $200 a month. So I would do 5% down. I would look into that program. I would get with a mortgage lender, a mortgage professional that is in the mortgage space every single day. I read an article on it. I've looked into it, but I'm not an expert with that specific loan program. So I would speak with a professional and they could advise you on it. But from what I've read, that's going to be a really great offer for people that are renting, that are looking for ways in which they can, get into the first deal.
Yeah. Talking to a mortgage lender, they're gonna have all the R&D loans. They're gonna have these different loans that might be available in your area or your city where you're at. So you're definitely gonna want to get that. Now, John, correct me if I'm wrong, but I always looked at it. PMI. Nobody wants to pay the PMI, but I wouldn't let PMI stop me. Like if I had a good deal,
Yeah.
and I wouldn't let PMI be the deal breaker. But hey, everybody's different. What do you think of that?
Yeah, PMI. I mean, it's just like it's like a broke tax kind of. Like they'll pay you $100, $200. You have to pay 100, $200 a month, but you get out of PMI once you have 20% equity in the deal, and you can refinance out. So if you're putting 3.5% down, and you have a 16.5% window that you need to equity that you need to build to get out of that PMI. If you're buying a deal that you can increase rents, you can do something to significantly force appreciate that property, and it might take you 6 months or a year. Who cares about $1,000, $2,000, $3,000 in PMI, right? Doesn't matter. If you're going to be able to invest 3.5% and then ultimately make a killing on the deal, that's the only thing that really matters in hindsight.
Yeah, and y'all look, again, not financial advice. Jeff said that's correct. Just this week, they rolled out 5% down on owner occupied multi units. Prior to this week, it was 15% down minimum. I didn't know that. I learned something new. So, wow. So, I would definitely be calling my mortgage guy, getting enrolled in that if possible, and being ready for the deal. Don't you think, John?
Yeah. So, one opportunity that I think is going to be huge that a lot of people are not anticipating is if you look at who owns a lot of these multifamily properties, like these mom and pop deals, small business owners. Like these people, they own a laundromat, they bought a duplex or a triplex or a fourplex. Like, oh, this will be my retirement plan. There's millions of properties owned by small business owners, and how are large corporations going to step forward and accumulate 40% of all single family homes? And when they say single family, I also assume that they're talking about residential, like 1 to 4 unit, a lot of these small deals too. So how are they going to do it? Well, there's going to be a situation where a lot of these property owners are going to be forced to sell, right? And so I think that it could be a great situation for somebody that's renting right now to kind of follow this formula where they add up all their expenses, they look at how much money they're spending monthly, they look at how much they're bringing in, and they start to try to reverse engineer that number to zero. And a good way is buying a really, really good triplex, a really good fourplex, moving into 1 unit. You have the other 3 units, maybe those other 3 units, 2 of which are paying the mortgage, 1 of which is building out a little nest egg. And then you move 1 tenant out at a time and you fix up the unit, put a little investment and fix it up, increase the rent. That new tenant comes in, the next unit, do the same thing, fix it up, increase the rent. Do the other one, fix it up, increase the rent. Then at the last one, you can move out of your unit and you can fix it up, increase the rent, and then you move into another deal. Maybe you refinance that first deal, pull some cash out to buy the next one. Like you're just being really, really strategic about how you do that. Someone said, can you explain more by what you mean of forced appreciation? Yeah, I can actually show you an example of a deal that I forced appreciated. I don't know if you can. Are you able to go on Google?
Yeah. Send it to me.
I'll text you. Or
you want me to what you want me to look up? I'll look it up.
You just go Google.
Uh-huh.
So 1168 West 38th Street.
1168 West 31st Street.
38th.
38th.
Street.
Los Angeles.
Yeah.
All right, let me.
And then you can click the Zillow listing. Once I see the screen, I'll be able to tell you.
Oh, okay. I was on the Street View, the Zillow list. Okay, I'm on the Zillow listing now. My boy John buying houses in Los Angeles. Y'all gotta, John, tell them where they can find your socials and stuff, because this is
this is John Williams. So let me know what's up there. I'll show you.
Yeah, here it is right here.
Okay, so I sold that property for $1,370,000, right? Scroll down. More. A little bit more until you see the price history.
So this was a duplex sold.
Yep. So I sold that at the height of the market, but if you scroll down a little bit more, hit show more right above. Oh, you're passing it. Nope. Scroll up a little bit.
More.
No, not that. Scroll up. Right there, show more. Scroll down a little bit. A little bit more. Yeah, so I bought it in 2017 for 420. So it says 425, but I got a credit at closing. And so this deal, those units in the front were disgusting, like roach infested, rat infested. It was disgusting. But we bought it, fixed it up. There's a little unit in the back. I tore down the unit in the back. I built a duplex in its place. After I remodeled the front two units, I refinanced. I pulled money out of the property, which offset all the costs in the back, which was about 250 grand to build out the back units. And then I was able to collect cash flow and then sold it at the height. So you can do these little deals, and if you buy it right and you pick the right area and you do the right deal, you make a lot of money.
You know, in The Wolf of Wall Street, when Jonah Hill tells Leonardo, man, you show me a check for whatever he made and I'll quit my job right now. That's how I feel right now. So John, you're telling me you bought this in 2017 for $425,000 and you sold it for 1.3 million.
Yeah.
That's that dude, that is what this is about. So Antonio said this, so go 3 to 4 unit deal figure. Yeah, because Antonio, you're not, if you get a house, you're not going to be, John, correct me if I'm wrong, you're not going to be able to get that finance and that FHA deal on the duplex. You got to buy the duplex, the triplex, or the fourplex first, correct?
Family too. It's 1 to 4 units. But the thing is, with single family, you don't really have like the only real equity play that you can create in a single family is fixing it up, renovating it, selling it to a new buyer. You're not selling cash flow. Like this deal, for example, the entire deal, the front unit was one unit was renting for $425, another unit was renting for $925, and there was a back unit running for $700. At the end, after I fixed up everything, that building was pulling in over $8,000 a month. So you took it from 2,200 to over $8,000. It would cover debt for $1.3 million. So back then the mortgage rates were probably 4%, 3.8%, right? So their mortgage might have been $5,000. They're pulling in 8. They're like, okay, they're making money. They have an asset. But now the problem is that if you look at where that area is, right, USC is right there.
Yeah, I saw USC on the map. So that okay. So you know the area.
Yeah.
And so, look, y'all, keep going, John. I'm sorry.
Yeah. So if you pick the right area and you buy the right deal, if it works out well, you end up making a small little group of money that you could roll into another deal.
John, how mad is this guy in 2003 sold it for $293,000? I'm assuming that dude's probably rich, but man, he's got to feel.
No, a lot of people in that area are broke. LA, everyone has this belief that people in LA are rich, but a lot of people in East LA, a lot of people in South LA, they bought these properties years ago, right? And so they might have equity in their homes, but many of them don't. They refinance, they pulled money out. They're not in the best situation, especially over the last couple of years. So we're going to see a scenario, I believe, coming soon where you're just going to see a lot of people trying to get up underneath these deals. So if you're able to move in and pick up some of these opportunities in areas that make sense, I think you're going to make a lot of money.
John, I know we're running out of time, man. Y'all, look, John, appreciate you coming on. Your time's valuable, but man, if you got time we got a couple more questions. You got a minute? Yeah. So Arak said, tax noob here. I'm a tax noob too, man. But how would an owner-occupied duplex to fourplex work with property tax in Louisiana's homestead exemption? So I believe that if you're living in it and you're occupying it, that you can have the homestead exemption on it. But again, talk to a real estate agent or mortgage professional. That's not my forte, but I think so.
Yeah, I don't have any comment on Louisiana homestead exemption. I'm not an expert in Louisiana.
All right. So Antonio said, so at the current moment in the market, should I wait or look aggressively? I'm going to go first on this one, John. I'm always looking. John, I look at Zillow like every single day. I have friends that are realtors. I talk to them every day. So I am always looking. If you're not in the game, then you're not going to, the deals aren't going to just come knock on your door. You have to be, like John, when John bought that double, I bet you did a bunch of research on that neighborhood. I bet you knew businesses that were opening. You knew that USC was right there. So you got to put the work in beforehand, right?
Well, so that deal, it was interesting. I remember one night I was laying in bed watching a YouTube video and I'm like, what the hell am I doing? I'm just sitting here watching a video. I'm not doing anything. Like I'm making a little bit more money than I did last year, but I'm not moving the needle like in a significant way. So I looked up online they did a class called the Minority Ross Program. It was for real estate development at USC, like literally in the campus. And I'm like, okay. And so I quit work for 3 months, and I paid $5,000 or $5,500 to go to this class. And I went to the class every single day, Monday through Friday, from 7 a.m. I get started early, 7 a.m. until about 3:30. And I would show up, and in that class, there was a bunch of people that were architects, city planning, all these different people, all these different professionals. And the purpose of the class is that they would give you these random locations in LA, and they would tell you, find the highest and best use of this asset, of this property. And you would compete against all these other teams. And so I was constantly looking at things from like a different lens and a different perspective. But rather than getting there at 7 a.m., I would get there a little bit early, 15, 30 minutes early. And I would every day. And then I would start looking at the area. I'm like, you know what? This area is prime. There's a metro coming in. And then I would start looking around, and then I realized, hey, these prices are cheap. Right now, I'm renting in Hollywood, $1,400 a month. I could go buy one of these deals for $1,700 mortgage payment, and I'm collecting rent on the other units. And then I literally bring the deal to class, and I'm like, what do you think is the highest and best use of this property? Asking people that were like architects and people, and they're like, oh, I would do this, I would do that, I would do that. I'm like, that's smart. I'm going to do that. And then I just bought the deal, and it was all because of that.
John, if you don't mind me asking, did you do FHA on this, or how much did you put down?
20%. 20%.
Okay. Yeah, because there's a lot of people that go back and forth in that. I believe, look, it's all about your debt threshold amount of, some people don't like having that debt burden. I look at it, guys. I've always looked at it. What do I have to do to get in a deal? And but the least, if I can use the bank's money, I do try to do that. Because you end up selling the house anyway, so you got that money back anyway.
Yeah.
Jeff said they get the exemption on the unit that they're in, not the 3 rented. Well, yeah, that's what I'm saying. Like, just because it's a rental property, you still get a homestead exemption, which lowers your property tax. And if you want to vote, I believe you have to have a homestead exemption in the parish that you vote in. But so John, so that was your first deal, that duplex?
No, it wasn't my first deal. It was my first like value add type of deal, though.
And you said they had a unit in the back that you tore down.
Yeah. There was like a house in the back, but it was like built in 1901. Like it was like the floors were like this. It was just like destroyed. But there was an alley behind the property where you could bring through parking. And so it was zoned RD 1.5. You could build 4 units. There was already 2 in the front. So we basically just duplicated the front duplex to the back, but rather than making it 1 bed, 1 bath each unit, we did 2 bed, 1 bath for each back unit.
And I'm assuming you represented yourself when you sold it, right?
No, I actually had an agent sell it. So we moved to Florida. He was handling all the showings. He was handling everything.
Wow, well, man, congrats on, man. I'm very impressed in that. Again, I'm looking at, when we see deals like this, guys, what John is predicting is going to happen is that there's going to be more deals like this. I mean, this, maybe not, at this appreciation, but it's more about, don't worry about the interest rates. Don't worry about the insurance. Don't worry about Biden. Worry about area. Worry about location, right? But
one thing I'd add to that is that like people need to realize that inflation is only going to likely get worse, and the world's going to get more and more and more expensive. It's not going to 2%, 3%. I actually have a video. I literally dropped it on this live stream while we're recording. And they said that inflation is not going to hit 2% for several years. It's not ever going back to 2%. It's never going to go back to 2%. And I think inflation is going to actually get worse. And the reason for that is because if you look at what's going on with this climate discussion, how do you transition from fossil fuels to a whole new energy grid and keep the cost of living the same? You don't. Food prices are going to go up. Utilities are going to go up. Insurance is going to go up. Everything that you buy that's getting to you on a ship, an airplane, a truck, it's all costing them more. It's going to cost you more. So if you're going to buy a deal, just make sure you're putting yourself in a business that's going to continue to make more and more and more money to offset the cost of the world that's coming.
Oh, look, it's terrifying, guys. I've considered selling all my properties for a lot of the stuff that John's saying, but I go with my gut on a lot of my business decisions. I'm wrong a lot, John. I've made a ton of terrible investments, terrible business decisions, but I got more winners than losers, and that's really what it's all about. But John, look, I know you got, man, I'm down to rock as long as the questions are coming in, but whenever you got to go, brother, I know you got a busy schedule, man, but I do
We got a
appreciate
couple
you coming
questions.
on.
We'll run through a couple more questions, and then I'm going to head off. I got a couple things I got to take care of for the end of
Yeah,
the day.
guys, maybe 5 or 10 more minutes. If y'all got any other questions, put them in the chat. Anything, real estate, business. I'm not an expert on credit, but John has a credit repair company, and he gives free consultations. So I think that if I was one of y'all and I was in it wanting to get in the game, that'd be where I'd start. I'd probably start with getting my credit, getting that situated, and it discourages people, John. It discourages so many of my friends. Exactly what you said. They co-signed a car to their girl, but John, they loved her. They loved that girl. That girl got her tattoo of him on a heart on her arm. They loved it. You don't understand. You don't understand, man. She's got a job. I got a job. I'm making money right now. And then they get in that situation you described, or they miss a payment because they had their cable service at their apartment, and they left the apartment or the house, and they didn't cancel the service, and the bill came on. And so Eric just asked a question: what are you looking for in a good real estate agent, John? I'm gonna let you handle that one, but I got something good for that. But you go first, John.
So a real estate agent's job is, it's always the best time to, unfortunately, it's always the best time to buy and always the best time to sell. So realize that they're getting paid based on the completion of a sale. In many cases, the better the agent is, probably the higher of a caliber buyer that they serve and the higher of a caliber seller that they serve, because they can't get away with pushing overpriced inventory as easily as when they're dealing with a sophisticated and savvy buyer. That buyer knows what they want. They understand the type of product that they're looking for. They understand what they want to pay. And that high-end real estate agent that has experience with that type of buyer is able to go out there and supply real value for the buyer. The problem is when you have a run-of-the-mill real estate agent, like 95% of them are, that they just pull inventory off Zillow and they're like, oh, buy this. It needs a kitchen. You could probably sell it for this. That agent they're not committed to having that best possible outcome. So I would never trust the real estate agent's opinion before buying a property. At the end of the day, the buying decision comes down to you. The real estate agent is there simply to serve. The real estate agent is, I learned this later on. I thought when I was younger, I watched like $1 Million Listing, like, oh, they're making the real money, not knowing later that the wealthy, they're just servants to the rich. They're like a busboy or like a maid. That is how many of these wealthy people view real estate agents. So you need to view them as someone that's going to facilitate a transaction, and you need to be educated enough to be able to go through and do the deal, knowing that you're making the right decision.
Yeah. So let me add to that. So guys, I took the test to get my realtor license maybe almost 10 years ago. I failed it so bad. I thought I was in the wrong test, John. I'm like, did I even take the right test? But then I start thinking what John said, and I start, from buying properties. And then I realized, I said, wait a second. I don't want to be on this side of deals. I want to be on the other side of deals. I want to be the guy, like he said, making my realtor do what I need them to do. So what I look for in a realtor, I look for one that knows the market, meaning that if a house comes for sale, like say that double that John showed us, that realtor is going to know, dude, USC's in this area. This is the rents. I mean, I'm an analytical guy, and I want my realtor to be like, like a trained, like a trained sniper, like a trained, hitman, where he knows everything I don't know, and he's able to fill in those blanks for me. So, you just got to meet with them. You got to talk to a bunch of them and have them send you deals and talk to you about deals and see what they know. All right. Antonio asks another question. So I'm currently building my credit. I have just got a new vehicle. I'm getting married next year. Congrats. And paying off debt. What is the fastest way to build my credit? I have no credit cards and student loan. Antonio, wait, you have no debt? I have no credit card debt, you're saying. So you have credit cards with no credit card debt. If you don't mind me asking, Antonio, do you know around about what your credit score is? But I'm gonna let John take this one because this is his bread and butter right here.
Yeah, so they'll look at your credit mix and look at what different lines of credit you have, what your payment history is. They're gonna look at everything and put everything into an algorithm to kind of get a general profile of who you are as a borrower. So if you don't have credit cards and your student loans, you don't have them, I would suggest getting secured cards, and I would first make sure that you don't have anything negative and derogatory on your report that you're unaware of. So I would look at your report and I would go through it to make sure that everything is on the up and up. But I am very curious what your credit score is right now.
Yeah, so I'd have to, and again, guys, I'm not a credit expert. John is, and Antonio, I put the link to John's website. He does a free consultation, so definitely I would take advantage of that if I was you. Getcreditfast.com. Greatcreditfast.com. It's in the chat. So I'd have to kind of know your score, but he's right about the secured credit cards. John, I heard one a while back. I don't know if this is true or not. I was at a real estate seminar. And what the guy said was, it was DJ Envy. If y'all watch The Breakfast Club, he said that if you go to he named a jeweler, it's one of these high end jewelry stores, and you can call them and open a line of credit for like 50 G's. You know, these high end jewelry stores will give you these line of credits, and just by opening that, I'm not telling you to go buy Rolexes and watches there. That's no bling bling. But if you go do that, it boosts your credit up. Is there any merit to that?
I've never heard of that. So a lot of people will talk about different things, and we hear like you wouldn't believe. Oh, does this work? Does that work? There's always like a trick or a gimmick or things like that. You just want to be careful. You want to be careful when they say that they can do this to boost your score, or they can do like a credit sweep or some of these things that are just, they don't make any sense. You want to be really careful when you're, getting involved in, in dicey type of situations that promise you the world.
Yeah. So Antonio said he's got a 620 score, but just dropped due to an unknown out of state bill from a breakup. And that, John, that's exactly what I was just saying. Yep. That so many people, it's the system, guys. The system, it's really a flawed system, the way they build your credit score. But so 620 is pretty bad. Not trying to be mean. That's pretty bad because
it is. So, and I'm just going to be transparent because I think honesty is the best policy. A 698 is the average. So out of 205 million Americans, right, the average of them have a 698 credit score. So that would probably put you somewhere in the bottom quarter percentile of them or close to it, all because of one situation. And now I'm not saying that, see, now Antonio's now at his 565. So if you get that one problem removed from your credit report, just that one problem, you would be shocked at how your score would benefit. So one late payment can drop your score upwards of 180 points, just one, and it will sit on your report for 7 years. So it's really crazy because when you're factoring in a mortgage, you're looking at this. The difference between good credit and bad credit on like a $500,000 loan might be $200-300 a month, but over 360 months, you're looking at like an extra 80, 100 grand that could have been invested in other deals or your future education or whatever it may be. So put yourself in a strong position and get your credit squared away before you try to buy, even though right now you probably wouldn't even be able to get a loan at 565.
Yeah. And how frustrating would that be? Like that deal that I showed that John did. Imagine that deal comes up in your town, and imagine that, you have a job and you have a W-2 and you have a mortgage lender and you have a realtor, and then you can't get it just because of a cable bill, an unpaid cell phone bill, a car payment, or something crazy like that. So I don't know too much about it, guys, but
one thing to add is that many people think I'll just go pay it. It's $100, $200. I'll swallow my pride. I don't owe it, but I'll just pay it. What happens is it's a charged off account, meaning that creditor took a loss with doing business with you. They submitted this information to the credit bureaus, and they submitted this against their income for the business. So they took a loss, right? So they don't have to pay taxes on that. Now, when you pay that, it doesn't update and remove itself from all three credit bureaus. All it will do is update the balance. So it'll be from a $100 balance, hypothetically, to a $0 balance, but it will still show as charged off. And it will still sit there for 7 years from that date. So you want to dispute it across all three bureaus, not pay them.
So dispute it, not pay it?
Not pay it. Because if you pay it, it's not going to remove itself from your credit. That it'll still be on your account as a charged off account. So you have no financial incentive to pay it off once they submit that as a charged off account in your credit report.
Yeah. So again, guys, anybody joining us, this is John Williams. Make sure to give this guy a follow and go to greatcreditfast.com for a free consultation. John, I really do appreciate you coming. I mean, I learned some stuff on this, but you're really making me get, want to get my ducks in a row because John, I lost my house in a tornado that happened last year. So I've been sitting on my insurance money and I'm waiting for that crash. Antonio, you're welcome, man. But don't thank me, thank John. Because he's dropping us with some grade A intel, I'd say. Well, guys, if y'all don't have any other questions, I'm gonna let John go. I know he's a busy, in-demand guy. John, anything you want to leave my audience with, my brother?
No, man, it was great connecting with you. Great talking with you guys. And at This Is John Williams on YouTube or on IG. We can connect over there.
All right, y'all. Well, I'm taking off. Thank you so much for tuning in. We're going to be doing more live content like this with Q&A. So if you're watching this stream later, definitely let me know in the comments who you want me to have on or any questions you want me to ask. Anyway, guys, I'm out. Thank you so much for tuning in. Peace.